4 as well. So today we are going to start the balance portion of credit rating. Good morning, Anand. Good morning. Okay, so in this one, we are going to cover the following things. One is standard risk rating for any business. So there is a scale which I'm going to show you. Then we have tried to cover key factors which affects the rating of a bank and insurance company. So we'll discuss about what are the key components in a bank which is being observed by the rating companies, and there are certain key components for an insurance company. Now, like other sectors, every sector, every industry has got certain key components. So we have confined ourselves to banks and insurance company. Then the method of credit rating of insurance company. And we will talk about macroeconomic factors affecting credit rating. I'm sorry, this has come twice. Macroeconomic factor, this has come twice. No, sorry. One is macroeconomic, another is microeconomic. Sorry. And last but not one is PESEL norms. And then lastly, we are going to discuss CAMELS rating. So that's how we proceed for today. So this is a risk return matrix where the likelihood of default and the impact. These are the two is given on the scale where it is low and medium, low, medium, medium, and high. Next, we are going to Praveen, in banking, the term is called PD, that is probability of default. Now, when we talk about probability of default, that is about the portfolio or a customer specific. Rather, I would say it is a customer specific. When we talk about loss given default, that is the outcome of the PD. That is like when there is a default, then how much loss will be there. Correct. So likelihood and impact, absolutely true. The likelihood and impact. So if we go to this PPT, this particular figure, we see where the likelihood is high, the impact is high. Where the likelihood is low, impact is low. So where the probability of default is low, the LGD is low. Where the probability of default is high, LGD is high. So these are the key factors which are considered while rating of banks. First one is capital adequacy, then asset quality, then earning and profitability, liquidity, and management quality. So we are going to discuss each factors. Now, when we talk about capital adequacy, we talk about two types of capital. One is Tier 1 capital, another is Tier 2 capital. So when we call Tier 1 capital, it represents the highest quality of capital and serves as the core measure of the bank's capital strength. So CET1 capital includes common shares, retained earnings, and other comprehensive earnings. It provides the most significant loss absorbing capacity of the bank. And Tier 2 capital consists of instruments such as subordinated debt, loan loss reserves that provide additional loss absorbing capacity. Now, if we compare this with a simple balance sheet or simple financials of any kind of company, then we see that there is a provision called provision for bad debt, provision for loss, which we debit in the PL account. So that is something which we create as a provision or contingency reserve in case there is a loss, in case there is a bad debt or a default, right? Similarly, can anybody say what is the provisioning norms of the bank? When does bank starts provisioning of a portfolio? Any idea? And how the provisioning goes? exceeds 90 DPD, you are saying, right? 90 DPD. So when it crosses 90 DPD, right? So the moment an account crosses 90 DPD, so one particular, it's not that one particular EMI is not paid for 90 days. When there is a 3 EMI default, that for 90 days there is no payment of either interest or principal, then the account is termed as an NPA, non-performing assets. And from there, they start doing provisioning, and there are certain provisioning norms are there laid down by RBI. So accordingly, they start doing provisioning of the account. Now, this provisioning is the tier 2 capital, what they are saying. Like this, you are creating a capital, you are setting aside a fund from your earnings just to absorb the loss. So suppose I make a loss in the portfolio amounting to 500 rupees, and I have a provision of 800 bucks, then obviously, so this 500 I'm going to set off from my provision, right? So there are certain accounting rules, so I'm not getting into that. So the purpose is this, that I have created this provision or reserves. The main purpose is I want to set off my loss with the provisions. So that is the main objective, the main purpose. But this is a secondary one. This is something which is not the core capital of the bank. When we talk about the core capital of the bank, it includes the common shares, it includes my retained earnings. So as a whole, it includes my net worth. So what is my net worth? And that gives me the core capital in the tier 1 capital, which is basically the main strength of the bank. Any doubt till now? Praveen, the Basel norms is followed how stringently? Currently, I think the capital adequacy ratio is adequately maintained. And for the banks who doesn't do it, there are a lot of issues. So I cannot give you the exact figure. I need to search it. Yeah, for European banks, definitely it is important. And especially after the Lehman Brothers issues, that has become extremely important. But then I have to check the actual number of provisioning and actual number of the Basel. But Basel I have covered. So I can give you the figure which is indicated by Basel. I'm sure you would be aware of this. But when it comes to Indian banks, I don't know. So whatever. See, it is very like, you know, you can see if you look at the financials of any bank, which is available in the open source, you can at least understand what is the net worth they are keeping. So what is the tier 1 capital compared to the total AUM. AUM also you will get. So that way you can see whether they're adhering to Basel norms or not. Like you can check any bank's financials, and then you can find out. So since you have raised this point, definitely I'll try to get it, and I'll definitely provide it to you guys. So since you have raised this topic, let me find out in case I am able to find out any financial of, say, any bank, Indian bank, say it's actually or net worth of Axis Bank. So this is the net worth of Axis Bank. 13,17,326 crores is the net worth of Axis Bank. Now see AUM of Axis Bank. It's not coming. Total asset is 13,44,418 crore. So if this is the one, then they have adequate capital. Yeah, presently it is 8%. Correct. Presently it is 8%. Right. But now what is happening, like currently, if you see, even if there is a rule which is announced for the fintechs also, even they have to keep a minimum amount of capital. Next is asset quality is a critical, Anand, but that is the figure. Asset quality is a critical aspect of bank's financial health and stability. It refers to the quality and performance of a bank's loan portfolio and other assets. A bank with high asset quality has a lower risk of loan defaults, non-performing asset, and credit loss. So this is all known to us. There are certain key aspects while evaluating the asset quality of a bank. One is NPA, second one is provisions, then credit risk assessment quality, concentration of portfolio, collateral and security, delinquency rates, asset classification, and stress testing. Now, NPA, we know more the NPA bad it is. We all understand that. Provisions also is similar. It shows the trend of delinquency, because the more you create provision, it means more is the number of delinquency and NPA is there. Now, the second aspect of provision is how much provisioning actually you have created. So I can tell you one example, which RBI has strictly said no on this, that is restructuring. So when we talk about restructuring, what does they do? What happens in restructuring? What happens in restructuring? So it is like, you keep the ball rolling. Yeah. So suppose I have a delinquency in my account. There are 6 EMIs overdue in my account. What I want the bank to restructure it. So I say you club entire overdue along with my entire principal outstanding and generate a fresh loan, generate a repayment schedule. So this was a very common practice followed by many of the NBFCs, especially before this reporting. So when the time comes to report your portfolio to RBI, that what is the percentage of NPA you are having, what is the percentage of delinquency you are having, there's a common practice among the NBFCs, especially I have seen, and I'll not name those NBFCs. I have worked in those NBFCs where they used to do it. They used to restructure loan, and at times they used to restructure loan without even informing the customer that your loan is getting restructured. Why? Because on books, they have to show that delinquency is much lower, which is extremely bad strategy. And currently restructuring is totally, stopped by restructuring. So here, there's a question of transparency of showing exactly how much provisioning I am keeping. Next important point is credit risk assessment quality. Now, when it comes to credit risk assessment quality, you can pick up a portfolio, you can pick up a sample of a portfolio and see what kind of assessment quality is being followed. Now, there is something called risk assessment. So there is a basic difference between risk assessment and credit assessment. And there is something called hindsighting. I don't know whether you guys, I'm sure you guys would be aware of this. Hindsight. What is hindsighting? Yeah, am I audible? Can anyone tell me what is hindsighting? What is hindsighting, Yashwant? It's back test. True. So what is back test exactly? What do we check? No, it's not knowing about the future. That is not back test. No. So suppose you have picked up 5 cases. 5 cases from a portfolio of 50. Right. Now, you know the credit policy and there are certain documentation policies are there. Right. When I talk about documentation policy, say for an example, when I talk about, my screen is visible, right? The notepad where I'm typing. It's visible, right? Yeah. So the credit policy, there is something called LTV, then ROI, then tenor, most important factor, then asset type, then deviation marked or not, proper mitigates of deviation mentioned in the can or no, right? Now, when I talk about LTV, say the policy says you can go up to 80%. Whereas in actual, you have funded 90%. Now, once you are funding a customer with 90%, that is fair enough. You can always do that. But there has to be certain mitigate, certain strength of the customer. Now, I am giving this extra 10%. That has to be mitigated by certain, certain covenants, certain mitigates. Because of this reason, I am giving 10%. Next is ROI, which is basically a risk-based pricing, which is suppose mentioned as say 13%. Whereas in actual, you have given approval for 11%. Then again, the question comes, what is the mitigates, right? What is the mitigates? Tenor, why tenor is very important? Can you tell me, especially when you are into asset financing, tenor becomes extremely important. Why this is so? Your loan tenor, whether it is 3 years, 4 years, 5 years, becomes extremely important. Why this is so? Yeah, one is cash flows of the company and second one is, so why do we have 20 years for a home loan? Correct. So why do we have 20 years for a home loan and 5 years for a car loan? We have 20 years for a home loan because asset depreciation is not there in home loans. At least for next 25 to 30 years, the asset will get appreciated. So you are in a much risk-free zone. But in the car loan, car or any other machineries which are depreciating assets. So the longer the period, In case the customer becomes defaulter, then what do you get? You get much, much lesser value compared to your cost. And other real factor is, so I just open the notepad. So what happens? If you carefully look at a repayment schedule, there are three portions, right? One is interest. Second is principal. And the third one is EMI, which is a sum total of your interest and principal. Now, in the initial period, in the initial time, your interest will be more. You will recover less principal, but the EMI will remain same. So this is say equal. So your interest more, the longer the tenure, the lesser the principal you recover in the initial phase. Yeah, individual earning age is something important. I'm coming to that point. So longer the tenure, the lesser principal you recover. So if you compare the principal recovery in first 1 year in an auto loan is much higher compared to first 1 year in a home loan. You can do it. You guys have repayment schedule for your own loans. You can check what is the percentage of principal you are recovering or getting recovered in first 1 year in an auto loan, that is a car loan, compared to first 1 year in a home loan. The home loan percentage wise principal recovery is much, much lesser because it has got a long tenure. Right? No, not because of that. Here, tenure is very important. That is something separate. Tenure becomes, even if after registration, you have minimum 15 years to 20 years. Normally people go for around 20 years of home loan. Correct me if I'm wrong. Please correct me if I'm wrong. Normally people go for 20 years. Yeah, now even people are going for 30 years. Yeah, it is okay when you are taking a home loan at the age of 25, 26. Then 30 years may you end up paying double the amount. Even in 20 years, if you calculate, if I go for calculating, if I sell my property after 20 years, then the amount I have paid is almost equal to the property value I get. I said the property is an up. Then actually, the second question would be whether it is a right decision to purchase property in loan or cash. I would say if you are purchasing it in loan and you have additional sources of income, try to foreclose it as soon as possible. Then only you will actually get a considerable appreciation of the property. So if I purchase a property worth 50 lakhs and I take a loan of 40 lakhs, and then actually I continue the loan for 20 years, I would probably be paying 70 to 80 lakhs. And after 20 years, I don't know what amount I'll be getting for that property. Because again, in the initial portion, the principal recovery is less, interest recovery is much, much more compared to other kinds of loan. So it is best to repay by 10 to 15 years, and if possible, whenever you are getting some incentive and all these things, put it in the home loan. I would say that your principal comes down slowly and gradually. Probably you will end up at a lesser tenure. So that's why tenure becomes important. Okay, let us come back to our topic. Then asset type becomes extremely important, that which kind of asset you are funding. So now you are funding a home or you are funding an auto. If you are funding an auto, whether it is a used asset or a new asset, See, at any point of time, your principal outstanding should be lesser than the market value of asset, which is not practical to an extent for a period of say around 30% of your loan tenure. Say around 20 to 25% of the loan tenure initial time, your principal outstanding will be more than your asset market value of your asset. But beyond that, there is a break-even point where the collateral gap will be positive. Okay. Next one is in hindsighting, you see whether you have captured proper deviation or not. So a particular situation, a particular case might have a deviation at L3, L4 level, which the underwriter has forgotten to capture. So that is also a hindsighting, it's a process deviation, which they should have captured, and they should have taken approval from the correct person who is authorized to approve that deviation with the right mitigates. So these are all we call it hindsight, right? So this hindsighting gives a credit assessment, credit risk assessment quality. Now, I don't know whether you people were ever, involved in any kind of securitization activity or not. I was, especially when Reliance Capital was selling their portfolio to Bank of Baroda, the SME portfolio, they had sold it to Bank of Baroda, and the construction equipment portfolio, they had sold it to Magma. At that time, it was Magma. And the Magma guys had done thorough testing of each and every file. They initially took a sample, then they said, we will check the entire portfolio. And the complete hindsighting they had done, they were raising question on each and every point on the cap. So this is something which even RBI can do, even any auditor can do when it comes about assessing the quality of portfolio of a bank. The next important thing is concentration of portfolio. So what is concentration of portfolio? Any idea? I'll definitely throw some light on that, but want some kind of input from you guys as well. What is concentration of portfolio? Correct. Right. Correct. Consortium loan might be for a big customer. So I'll give one example. In an NBFC, in a particular region, the total portfolio size is 130 CR. And one single strategic customer is having 30 CR. Out of this 130 CR, 30 CR was given to one single customer. It's obviously a corporate customer, a strategic customer, right? Now, this is one thing. Second concentration is you are not spreading portfolio wise, you are investing in only, say, for an example, commercial vehicle loans. Vehicle loans. Say you have 500 CR to invest in loans. You can only invest in one particular kind of loan where you believe that you have expertise in that. Whereas you can split it into 5 different portfolios, 5 different line of business, and you can allocate the fund. So what happens in case you are only funding into commercial vehicles and there is certain, turbulence in the sector, say for an example, There are certain government rules which is affecting the transporter. So I'll just give you a practical example. The one important problem in the transportation sector is, one is freight rate, another is the freight availability. And because of lesser freight availability, freight rate is coming down. It's again a demand supply question. Yeah. So cost of running is getting affected because of these two factors. Now, with a new commercial vehicle, paying in EMI and then maintaining all the operational expenses, then paying the EMI really becomes difficult. Really becomes difficult, especially for a customer who is coming into the business for the first time. Right. Yes, you have 3 vehicles to support. You are okay to do. Not an issue. Right. So that means you are concentrating on a single line of business. Your portfolio is concentrated to a single line of business. This is quite risky. Right. Second thing is location concentration, which nobody has said. I am only concentrating to a particular location of the country. In case there is any issue in that location, there is strike, there is political issue, there is flood, there is natural calamity, then I have high chance of losing money. So one is product concentration. Second is customer profile concentration. Third is your location concentration. Country, country, correct, Praveen. I'm sorry, I missed it out. Country, it's for a global bank. Now, for an example, what if that country wants to open a branch in Syria and want to start lending business? This is my question to Praveen. Suppose, for an example, a situation which we imagine that they want to start lending in Syria, right? So you are right, Praveen, that way. I'm sorry, I missed it out. So this is concentration of portfolio. Okay. Next is collateral and security. When I talk about collateral and security, I told you that something called collateral gap. So initially for say around 8 to 10 months is okay to have a principal outstanding more than my market value of the collateral. But after that, there has to be a positive collateral gap. So at any point of time, after that, if I have to repossess the asset and if I sell it in the market, I should be able to recover not only my cost, but there has to be something residual, something above the cost. All right. So how do you ensure collateral and security? What is the process? Question to everyone. How do you ensure this? Proactively. See, even if you continuously audit the market value, yes, you can do it and you can change your, max limit for that particular asset. This is one thing. Yeah, asset is registered 80 to 90% finance, lend 20% below market price. Okay, what else? What are the other opinion? Let us get few more opinions. Praveen, you are talking about the legal terms, but actually, see, if I'm a borrower and I raise my hand that I won't be able to pay my EMI, you take my assets, and I'm not creating any problem. I'm not saying that I will not allow you to take my assets, but there are two things which will happen. One, the bank takes my asset, the bank sells it at a lesser price because in the market is not market is not ready to pay a price more than X. So they sell it at X or might be at X minus 8, a distressed value. Then the second step, what bank does, they file a case for loss on sale. Commonly that term is called a loss on sale case. Now that keeps on continuing 5 years, 10 years. By the time probably the borrower is known. That is how it goes on. This is the practical scenario. And in India, it's very common. They'll raise their hand. No problem, sir. You take my asset. So a set of customer is there from whom you will not be able to recover. You do whatever you can. Even the police will not give you any assistance. I've seen those kind of borrowers, right? Then there is another set of borrowers that they will say that I have raised my hand, sir. You take my asset, no problem. You take it, and the price at which you will be able to sell it is much, much less than your principal outstanding, your accrued interest and accrued charges. So actually you are taking a hit on your portfolio. So proactively, there is something called depreciation grid, which is being maintained by banks. And you actually see what is the collateral gap in that. So I'll just try to show you one small example here. Just a moment. Let me take it out. Can you see my screen, guys? So there are two cases where first you fund and use a new asset, and the second thing is you fund a used asset, right? Then this is your principal outstanding. This portion is your principal outstanding. I'm marking it in yellow. And this is your market value of asset. So I'm marking it in, say, blue, right? So you can see till 8th month, your market value of asset is lower than your principal outstanding. Same is for used asset, but that is till 3rd month. From 9th month, you have started getting a positive collateral gap. That means what? If you need to repossess this asset before 9 months, you will be at a loss. And after 9 months, you will be at a profit. Right? So this kind of analysis has to be there. Okay. So that's why collateral and security becomes extremely important. Next is delinquency rate. So you all know that when we talk about delinquency rate, we say multiple things. A trend of delinquency. So when I call trend of delinquency, one sec, guys. So that means as a risk manager, I will start from first EMI bounce in percentage, then 30 plus in percentage, then 60 plus in percentage, then 90 plus in percentage, right? These are few things Okay, then obviously how much provisioning I have created and how much write-off, right? These all are the trends of delinquency. Now tell me one thing. First EMI bounce percentage, why it is important to look at first EMI bounce percentage? So say I have 100 customers, say rather I would say I have 1,000 customers who have been added in my portfolio last month. And this month their EMI is going to hit, their first EMI is going to get hit. Now, why it is so important that first EMI percentage, first EMI bounce has to be very low? Why? First EMI becomes extremely important. By any chance, if it gets bounced, like, the bankers will go mad. So one is intention to repay. Second, wrong profiling, correct. So probably we have choose a wrong profile. Correct. That means the credit underwriting process was not strong. In fact, senior risk managers, they say that if there is a single check bounce in the first 6 months, that means the credit underwriting was not proper. In case there is a check bounce in first 6 months, that means the credit underwriting was not proper. This is number one. Second important thing, probably the customer is not at fault. There could be certain operational issues. What it could be? The bank is in fault. What it could be? Give me a situation where the bank is at fault for the first EMI default. What could be the situation? So, overfunding means the customer has anyhow taken funding. It's not that he was forced to take that funding. And coming to linking of non-operational account, that is something you can, why a non-operational account will be linked. That is something, yeah, I can understand. Probably he has to meet his target, he didn't check it properly and he has linked it, right? Correct, Kamlesh. Nash mandate was not registered. Probably Nash mandate was not, it got delayed. It got delayed. That could be one reason. So that to combat that reason, what banks do, they take 2 checks for the first 2 months. Correct. So that is what they do. Not only first, normally 2 checks they take. They assume that for 60 days, it will take around 45 to 60 days. So some banks or some NBFCs, they do take 3 checks even. That for the first 3 months, we will put check. And that mandate they initiate, probably it might take time. Yeah, it happens. It happens to everyone. The next one is there can be certain commitment issue. So what that used to happen earlier, now that is that bankers, they do get clarification from the customer. What happens? The customer was given a commitment of 2 months moratorium, right? So I am taking a loan in the month of June and I know July, August, my EMI will get hit on August, right? So I am mentally prepared that my first EMI will get hit in August, month of August. But what has happened is my first EMI got hit in the month of July, which I was not even aware of. Now there is a tussle that no, I didn't get my repayment schedule. Your sales guy has committed that my first EMI will get hit on the 5th of August. Right. So yeah, in case of BT, the amount can get debited at both the banks and which can lead to a situation of tussle between the bank and the customer. And in that case, probably there could be a bounce in the second EMI. But when we are talking about a scenario where the first EMI is got bounced, so the customer himself is not aware that his EMI is going to hit on 5th of July, whereas he was told that his EMI is going to get hit on 5th of August. So he has not kept his account adequately funded, and that's why there's a bounce. So that can be possible, right? Second possibility of miscommitment is, what could be the second possibility of miscommitment? What could be the second possibility of miscommitment? So rates went up, interest changed is one part. That is something which bank is not at fault. So probably if the case is booked with floating rate, then obviously the customer is agreeing that rate will go up. Correct, Yashwant. A EMI committed is different from the actual EMI booked. So I have committed that I will give you a rate of 10%, whereas I have booked the case at 12% because I didn't get approval at the 11th moment. And I didn't even bother to inform the client that there will be a different rate from the rate committed and your EMI amount will be different. So that creates a tussle. Again, there is a difference in opinion between the bank and the customer. And in fact, currently customer can really, use their rights, and they can go to RBI ombudsman for that. That this was the commitment, provided there is a written commitment, and this has been given in actual, right? So that is the main reason for the first EMI bounce, right? Next is obviously we'll look at 30 plus, 60 plus, 90 plus, and all these stuff, right? Coming to asset classification, what is the overall portfolio asset classification? How many 30 plus, 90 plus, and delinquency are there? This becomes extremely important. Okay. Stress testing is something which you can do as a check that, like what is the condition of the portfolio. See, Tanu, my default is, even when you use the term default, even if my one check gets bounced, I am a defaulter. Defaulter means my check got bounced, means I have breached the commitment and I have become a defaulter, right? Yeah, I have not become my account has not become an NPA, that's okay, but I have become a defaulter. No. Right. Well, now I'll talk about the earnings and profitability, which are crucial indicators of bank's financial health performance. They reflect the bank's ability to generate income, to cover expense, and provide returns to the shareholder. When evaluating the earnings and profitability of the bank, several key aspects are considered. So when we consider the key aspect, the first key aspect that we consider is net interest income. What is net interest income? So one thing is, when we evaluate a bank or a lending institution or an NBFC or a microfinance institution, then there are certain then there are certain financial parameters based on which we keep on evaluating them. The first one is net interest income. What is that? It's a difference between the bank's interest income from the loans and investment and its interest incomes on deposits and borrow. So this is applicable only to bank, spread. So this is applicable only to the banks because they can take deposits. NBFCs, they cannot take deposits, right? So whatever my earning is from the deposits and whatever, whatever my expense is for the deposits and whatever I'm earning in the rate of name of interest is something which is my earning, and the differential amount is net interest income. Now that net interest income expressed in terms of percentage, right? That this is my net interest income in percentage. Now, how is that? Say I have total portfolio size of 5,000 CR, and my net interest income is 100 CR. Then what is my NIM? My NIM is this 100 divided by 5,000 into 100, right? It is 2%. It is 2%, right? The third one which we look at is non-interest income. So there could be wealth management fees, commissions from interest income. Now, there is something called debt syndication. Yeah, Bharat, please put it in the chat box. Please put it in the chat box.
Hello. Hello.
Yeah,
can you hear me, sir? Yeah. Good morning, sir. Sir, see, when we are looking at companies, okay, so we try to calculate the net interest margin at the end of the year. So in that case, you have the opening loans. I mean when you see the balance sheet, you can see it for 2 years. So you have the opening loans, you have the closing loans, and then you have the net interest income from the P&L. So, but when we compute this margin number, which is the right method, sir? Because when we divide the net interest income by the average assets, I mean the opening and closing by 2, that may not be the right method to compute, right? So, is there any other method we compute the net interest margin?
So I'll tell you one thing. So when we talk about the net interest margin, generally, when we talk about the entire portfolio calculation, it happens on an account to account basis. It actually happens on an account to account basis.
No, but if I want to compute it for the company, sir, at what is the net interest margin at which the company is lending?
How do you arrive, Bharat? How do you arrive at a company level if you don't know the summation of the total and how the result is coming? Achha, you want to tell me, you want to say that you want to compute on the whole company basis?
Yeah, right? I want to compute it for the company. Yeah.
So in that case, the closing amount is generally considered, and the closing amount that is on my this book size. What is the percentage of income I have earned? I understood your point, because probably the opening amount could differ and might be certain accounts which got closed in the interim. But in that case, that is the procedure which banks or NBFCs, they do follow. They check at the closing loan amount and the closing AUM, closing total principal outstanding, and they calculate the margin based on the closing one, not on the average. I hope
See,
I answered your question.
yeah, because see, generally what happens is in the fourth quarter, a lot of lending tends to happen, sir. So if we are booking, so the assets tend to go up significantly in the last quarter, but then the income is, which is on an accrual basis, is only accounted only for that quarter.
See, what you are saying is something logically correct, but when you are asking me what is the way that things are calculated, I am telling you the norm. You can counter the norm, but that is the norm.
Okay, sir. All right, sir. Yeah, thank you.
You got my point.
Yeah. Okay, sir. Yeah.
You can always counter the norm that this should not happen. I can always counter the norm that this should not happen. But this is what is happening. Okay. Next is, you might have heard about the syndication income. So there are certain NBFCs and even banks, what they do, they do syndication activity and they earn a fee. So that is one kind of additional fee they earn. That is a non-interest income. Could be a trading income, could be wealth management fees, could be some advisory services, right? All these are non-interest income. So that is also one, one determinant about how the financials of the bank is. Second is obviously operating expenses. Obviously, not only you will calculate operating expense, but also you will calculate what is the percentage of the operating expense compared to the operating income. Next is return on assets, is the profitability of the bank related to total assets. So how much total assets you have and how much return those total assets are giving you. Return on equity is also known to us, that what is your return compared to your shareholders' equity. Then there are certain efficiency ratios. We all know what are the efficiency ratios that compares a bank's operating expense to its net revenue. It reflects the bank's ability to manage cost and generate income. If your efficiency ratios are quite good, that means you are maintaining your operating expenses properly, and like it's a good situation for you. The last but not the least is how much provisioning you have kept for the loan loss, so that you can take the hit easily, right? Well, liquidity is a crucial aspect of the bank's financial strength and stability. It refers to the ability of a bank to meet its short-term obligations. So what we check in the liquidity, we check cash position, we check liquid assets. So when we talk about cash position, it is not only cash, but cash equivalent as well, right? It's an indicator of the liquidity. Next is if I have to borrow, if I have to lend, and I don't have cash, and every time I have to lend, I have to borrow money. So have you faced a situation that a scheme is going on and all of a sudden the bank or the lending institution has stopped funding because of money? Any situation have you observed? The scheme is going on and they have crossed their target and now they don't have money. They are waiting then to borrow money and then they will lend. Doesn't happen with banks generally, but I have seen it in an NBFC that they are out of fund. And that NBFC is currently in a very bad state. SREI. Anybody heard about SREI? SREI. That happened when Paisa Ka Nilami was going on. So much funding was given. And after that, they had to stop funding all of a sudden because they don't have any cash for lending. Okay, the next important thing is your source of fund. Normally, if you are an NBFC, then obviously you have to, there are two things. One is either your own borrowing or else your own money. Either you are borrowing or own money. So either you raise debt or you raise equity from the equity market. Two ways. That is not your own money. And second thing is you put your own money into the business and you do lending. But for a bank, it can be interbank borrowings, it can be customer deposits, right? those are the funding sources. Next is liquidity coverage ratio, which is very important. LCR is a regulatory requirement that measures the bank's ability to withstand a short-term liquidity stretch scenario. So when in normal business scenario we talk, we look at certain ratios. Okay, you have NCD, Srei. Okay. Yeah. Shrey had done a lot of goofings, actually. Lot of goofings. So they were the company who has who had structured, who has restructured the loans without even informing the borrowers. Yes, right. They're the company, they restructured multiple accounts without even informing the borrowers, which is a crime actually. No, Srei, actually what happens, Srei, there are multiple reasons. One thing is their due diligence quality is quite poor, number one. When due diligence quality is quite poor, then obviously you end up doing bad loans. Number two is their tussle with customer is because of their goofings. The goofings are, you have adequately funded, you have kept your account adequately funded on the due date. They have not sent the check, they have not deposited the check. But once you take out your SOA, you see there is a check bounce and a check bouncing charge is being raised. And also ODC is being raised, which is absolutely wrong. I've seen multiple customers are complaining about this, that no check was hit in my bank. My bank was adequately funded. And there was a lot of arguments. But then how could you, showing my SOA, there was a check bounce, and how could there be an ODC and all these check bouncing charges. So there are multiple reasons, but most important reasons are diversion of fund to its group companies in the form of loans. So you keep on doing this thing. That had been doing these things from 2001, 2002. But things have to, things has to come to an end. Wrongdoings have to come to an end. That is what has happened actually. The next point is loan to deposit ratio. It has to be healthy. Like you have a proper loan to deposit ratio, then obviously it makes sense. Then central bank facilities. Banks often have access to central bank facilities such as discount windows, standing facilities to bank fund. So if you have access to those facilities, fair enough. And how much stress testing you are doing? The seventh point is stress testing. What is the liquidity position under adverse scenario? So one is your favorable scenario. There could be three scenarios. One could be a favorable scenario. Second one could be a neutral scenario. And third one could be adverse scenario. Right. So stress testing checks in a simulated manner that how this portfolio is going to behave in an adverse scenario. Now, when we do stress testing, so we do you can say a 360-degree appraisal that my funding is restricted to these sectors, and what comes out if the situation is like that, there is a sectoral downfall and I don't get EMI for 6 months. How do I maintain my operational expenses? And then also, how do I maintain a positive, cash flow? Adverse scenario. And most important is the third point, the stress testing in the adverse scenario. Extremely important. Regulatory requirements, obviously, when a bank or NBFC is adhering to regulatory requirements, obviously, it means that fair enough that you won't have a threat from the government authorities or from RBI, right? Next, what plays extremely important is the management quality, which plays a crucial role in the overall performance and stability and successful of a bank. When we talk about management quality, means your leadership and vision, experience and expertise, risk management, corporate governance, talent management and succession, ethical standards and integrity, performance and results, adaptability and innovation. So I have say 1,000 crores, I can start a bank, right? But do I have that kind of experience, expertise, or resources to start a bank or start an NBFC? First of all, forget bank. Getting an NBFC license, do I really have that? And last point, innovation is becoming very, very important where currently there is a lot of change which is happening in the lending space, especially in terms of technology and AI. Am I ready to adapt to those technology and am I ready to invest in technology? It's very important. Currently, those days are gone where in Excel you used to do financial analysis. You used to take out ratios in Excel. You used to take out bank statement in Excel and the outcome of bank statement in Excel. Those days are gone. So currently everything is automated. You have OCR technology, you have AI, ML, everything to find out the analysis of your bank statement, GST, ITR, and the financial statement. So what is the mindset to adapt to this changing technology and how much I am ready to invest in this changing technology is most important and significant while you evaluate a bank or an NBFC. Just give me 1 minute time, guys. These are key factors which we check in rating of an insurance company. One is financial statement analysis. Second is again capital adequacy ratio. Obviously, in insurance company, you must have adequate capital so that you can give the claims. Next is investment portfolio analysis, risk management, regulatory compliance, and peer-to-peer comparison. Let us do one by one. Financial statement analysis is different for an insurance company compared to a bank. When we talk about financial statement analysis of an insurance company, the first thing which we see is revenue and premium growth. Obviously, because that is their revenue. For my bank, what is the revenue? My interest income is the major revenue. So for a lending institution, my interest income is the major revenue, right? For an insurance company, my premium is the major revenue. Next is investment income. Why investment income is important for an insurance company? Why investment income is important for an insurance company? Hi guys, am I audible? You answered a part of the question. There's a partial answer. Like when it comes to yes, correct. So they invest the money that they take in the form of a premium, and they earn money. They keep on building their wealth. Correct. So they have to deploy the money that they are earning somewhere, right? Claims ratio to loss reserve, very important. Why it is important? Why claims ratio to loss reserve is important? Correct. So think of a situation in COVID. What about the situation in COVID for the insurance companies and for the mediclaim companies? Nobody even expected. I think insurance companies did not even expect this. Yeah. So it is extremely important to check the claims ratio to loss reserve when you do rating of an insurance company. Next is expense ratio. The expense ratio measures the operating expense incurred by the insurance company as a percentage of the premiums earned. So if you are paying too much high salary for the resources, your expenses are too high compared to the premium you have collected, then obviously it's not a good sign, right? Yes, especially the commission. Next is what is the combined ratio? The combined ratio is the sum of the claims ratio and expense ratio. So that gives you more or less the actual picture of the outflow versus inflow. Now, solvency and capital adequacy, it means whether the company is having adequate capital or not, whether the company is solvent or not, in case there are too many claims which comes up, whether they will be able to meet the claims or not. And what if they're not able to meet the claims? What if they are not able to pay the claims? What is going to happen? What is going to happen if they are not able to pay the claims? So first of all, they will get into legal tussle with the customers. And currently, with the social media like Facebook, LinkedIn, Twitter, Insta, everywhere it will be flourished. So recently, my relative was declined for a cashless facility. She was said that no, you will not be given cashless. You would be given, you have to pay the bills first and you have to get it reimbursed. I immediately wrote to their customer care. I had looked in IRDA. I had sent a mail to National Human Rights Commission, and National Human Rights Commission immediately lodged a case. They had given a case number. Within 24 hours, they had approved that, okay, fair enough, it will be cashless. So this is the power of media right now. And also my sister has written it in the LinkedIn, mentioning the insurance company's name. This is the power of media. Just 1 minute, guys. Yeah. Next one is cash flow analysis. Obviously, we have to know what is the cash flow and how the cash flow situation is, and the regulatory disclosures. Just quickly have a look on the capital adequacy. One is risk-based capital. That is extremely important. So regulatory authorities establish risk-based capital frameworks that define the minimum capital requirement based on company's risk profile. So you can relate to this situation. Say for an example, me and there is another person, Mr. X. We both have approached a finance company for a loan. My CIBIL score is say around 600 and Mr. X's CIBIL score is say around 780. Considering the CIBIL score and overall profiling, I have been told that I will be getting 60% loan for the entire asset value and Mr. X is getting 90%. Right? Similarly, the regulatory authorities, they do a comprehensive check for the insurance company in terms of capital frameworks, and they define that what is the minimum capital requirement. So what happens how do I relate this? Because while purchasing the asset, looking at my profile, the bank is saying that Abhijit has to invest 40% capital in this project because he is risky, high risk. Mr. X has to give only 9%, sorry, 10%. So you will be getting 90% because he is less risky, right? Solvency margin is the excess of an insurance company's available assets over its liabilities. Capital structure is the insurance company's capital structure in case of mix of equity and retained earnings. So that is also something which you will look at while rating an insurance company. Then it is risk assessment and risk-based capital allocation. So whatever fund you are allocating as an insurance company, when you are allocating funds, so how many policies you have issued, and you segregate is age-wise. So for an example, if I do that, probably I split the age as 21 to 30, 31 to 40, 41 to 50, 51 to 60, and more than 60. These are the age-wise scaling I have done, right? So can you guys tell me who is at more risk and who is at less risk? Which customer is the less risky and which customer is most risky? So 31 to 40 is less risk. This is the least risk profile. Why I'm going to tell you the reason. This is more risky. This is moderate risky. Right? So what happens? Yes, 31 to 40 is a matured age group when you know that I have to pay my insurance premium. 21 to 30, just recently I have got my job. In a fluke, somebody has told me to get an insurance policy. I have paid first year premium, second year's premium I am not paying. So there is high churn. An obvious reason 60 plus is more risky because there is more prone to health issues and death. All right. Next is obviously stress test, so which we have discussed several times. What is reinsurance? Can you tell me what is reinsurance? Anybody? Okay. What is reinsurance? Correct. So insurance transferring the risk portfolio to other insurance company, right? And how much credible that company is. So I have, in case of emergency, in case of exigency, I have 1,000 crores of rupees to pay. So assuming a situation that all the customers whom I have issued insurance policy is either going to fall ill or are going to die, God forbid, right? So I have to pay a total amount of 1,000 crore. Now, I have to insure this 1,000 crore so that I get a support from that insurance company whenever things go bad. And I need to pay an insurance premium for that. Now, X insurance company is again reinsuring its portfolio to Y insurance company. And you are rating that X insurance company, you have to see what is the credibility of the Y insurance company. That is very important, right? Regulatory compliance, obviously insurance company must comply with regulatory compliance. That is, in India, it is So investment portfolio analysis is a critical process for insurance company to evaluate the performance of risk and composition of their investment portfolios. Here are the key aspects to consider when conducting portfolio analysis for an insurance company. One is asset allocation, diversification, investment performance. Asset allocation is something that how I have allocated the asset. So insurance company has X amount which they want to allocate into different investment instruments, and how much they have. So there are, analysts, especially they do investment analysis, and they see how they spread the entire money in different investment uh, options that is available, how they diversify, and how their current investment is performing. What is the risk assessment? What is the investment selection? And debt versus equity, government security versus bond. Okay, so all these things, and also with the trend analysis of their income from those investment is also something which is being considered. So that shows that is one important aspect while you rate an insurance company. Next is portfolio turnover. What is the portfolio turnover? Right? Investment guidelines, constraint, ESG factors, reporting and communication. So one important factor is dropouts. I have not mentioned it here. So I'd like to discuss what is the dropout. So for an example, you have issued policy to 100 customers this year. And next year, so for an example, last year, you have issued hundreds of policy to 100 different customers. And how many customers are not renewing this year is what we call as dropout. What is that dropout ratio? So if 20, say for an example, if something more than 10% is the dropout ratio, then it's really a concern that your 10% of the customers are not paying the second premium. Could be multiple reasons. One, in this last 1 year, they had not got proper service from your company. Second, in the last 1 year, your premium is very high, which is being compared by the customer, and they have shifted to a low premium company. Like I myself have shifted from Max Bupa to ICICI Lombard. Looking at the premium, Max Bupa, currently Niva Bupa, their premium is probably the highest in the market. So yes, Bharat, you can say it's a persistency ratio, right? Some call it dropout ratio also. Next is environmental, social, and other factors. That is very important. So how they are taking care of this, and reporting and communication is. Wow, that's a good information. Thanks. Yeah, hi. Another is risk management is a fundamental process which is also important for the insurance companies to assess and mitigate risk. So when we talk about risk identification, risk assessment, so Anand, you are saying insurance farm revenue schemes. Just could you elaborate it?
Yes, sir. Can you hear me, sir?
Yeah, I can hear you.
Yeah. See, we often kind of see in these reports like their revenue stream comes from par, non-par, and new VND business, APE, embedded value, and things like that. So I just wanted to understand, like between say LIC, the profit is less because some business vertical which generates like more profits, they don't have a presence. So I thought, having got opportunity and you're running through it again, like you
So
mentioned.
those are basically
Yeah.
nothing but different sources. I'll tell you one thing. For an example, you have heard about bank assurance, right?
Bank assurance. Yeah,
Yeah. So bank assurance is one way by which insurance companies, they do tie up with the banks and they sell their policies. Right. So currently, if you are working in a bank, even in the liability where you are selling CASA, you will have a target to sell insurance policies as well. Even health cover, right? Term
okay,
policies, all these things. So
okay,
like these multiple channels are there for insurance companies. So these are called revenue streams. So it can be happening from bank assurance. It can be happening from the channels, could be from
okay,
the brokers, could be from other ways like direct sales, and multiple things are there.
okay,
And also they are developing, like, you can say currently they do tie up with, you can say, different labs, different testing centers, those which are slightly big in stature, and
okay,
they offer mediclaim policies, right? If you see that
okay,
if you are having a mediclaim policy, the policy might give you a slightly high value policy, a free annual health checkup.
correct.
Have you seen that? Free
Ah,
annual health checkup. My policy gives me that option,
okay,
right? So they
okay,
do two things parallelly here. One is it's a give and take policy with those labs. So probably they have tied up with SRL labs or Lalpath labs. Then you
okay,
go there and do a comprehensive testing of your entire health checkup,
okay,
right? So that way they are giving business and they expect that whatever customer database you have, please share it with them, and you keep on getting calls that you get a health policy. We are having this tie up. So if you go to SRL or Lalpath, so probably we'll be getting this much amount of discount. What could be the other reason for which they do it with their existing customer?
yeah, they will know their problem and then they can increase the
Correct,
premium next year.
correct, correct. So they will increase their premium next year because in case they see I am having high cholesterol, high triglyceride, okay, or certain other indicators, they will increase my premium next year. Okay, or they can even decline my claim next year, that you are having this pre-existing illness for which we won't pay you.
You are not disclosed it at that.
No, I might not disclose it. I might not disclose it at the earlier because I might not be having that problem. But I have developed that problem right now. Yeah. So what you said is correct. You have not disclosed it. So say for an example, within 3 months, I'm going for a health checkup. After taking insurance within 3 months, I'm going for a health checkup and I have found that I have high diabetes and high cholesterol. That means I have not disclosed it. One thing. So in that case, they can reject my claim. Second thing is, say I am maintaining the policy for 2 years and in the third year, I'm going for a health checkup, and which shows that my certain levels are slightly elevated. Then what they will do, they will say that considering the risk factors of your health, I am enhancing your premium for the next year.
Correct.
So right. Okay.
Sir, also in these kind of companies, like here you talk about price to book, PE, valuation. I think here the valuation is a little bit different. Like we hear terminology like embedded value, and many other things. So you would also note like LIC, when they listed, it is okay now at 20-30%, like below the value. So that's what I want to understand. They're saying that their revenue stream is more coming from not the profitable line of thing, and the way the embedded value or the accounting is done also is reducing the valuation. So because this valuation is more complicated than the regular.
So I'll tell you one thing.
Yeah.
So if you look at the profit and loss account of any company,
Okay.
where there are two, you can see if you go to the notes, earlier we used to call it schedules.
Yes.
You go to notes and you see the breakup of the revenue. The revenue could be from operational activity, revenue could be from non-operational activity.
Okay.
So once you see that interest income or the income from the investment is much higher than the premiums earned, that means there is a problem. What you said is correct. So if you like, I have elaborately told you
Yes.
that this kind of analysis is done by analysts. So why insurance company? Why only insurance company? You underwrite any case, even if suppose a company is into construction, you see that the major portion of their revenue is coming from interest income or investment returns,
Correct.
and operational income is say 10% of the entire revenue. What do you analyze of the company and how do you can go ahead for funding of this company? And what they will do with funding,
Okay.
right?
Operational income has to be very much higher than the interest income.
So that
Yes.
means that means they are earning from operations.
Okay. Running the
Suppose
business.
as an insurance company, I have not been able to issue a single policy. I have not been able to sell a single policy. I have not got any premium. The only thing that is making my company run is my investment income. Is obviously something not good. Is it a good symbol?
Yeah, it's not good. But sir, but their the kind of premium, like as you mentioned in Warren Buffett, they will have so much of money. They can also multiply, like LIC, like will be having maybe a 1,50,000 crores or more, as a investment. And that if they put the in equity, that itself will be a multi-bagger.
That can be a multi-bagger, but what about the operational aspect?
Yeah. Okay.
I see
Long term.
you have opened a
When claim keeps coming, then they will keep coming. That will be keep reducing. That's what you say. Yes.
So what happens is that, see, it's not only about claims. So I have opened a company to do business, right?
Correct.
If my operational income is comparatively much lesser compared to the investment income,
Yes.
then obviously,
Eventually it will come back.
Eventually that's a kind of red flag,
Correct.
what I can see.
Yeah, exactly. See, that is what actually we see regularly in market evaluations. They call something like a VNB. VNB, I think it's a new business or something like that. Maybe somebody in that sector will know that word. That's what they measure, like between SBI insurance, HDFC insurance VNB and LIC's VNB. That's one of the comparisons they do. And the par and non-par is more about the profitability. So
are you referring to the LIC IPO that came out?
yes. I'm just comparing, say, between LIC insurance and say SBI insurance and say HDFC. These are
Correct.
some of the factors they compare: embedded value, APE, VNB, par and non-par.
Correct. So actually, LIC, for the qualified investors, they were not interested to invest in LIC IPO.
Yes.
So I have talked to multiple people who are genuinely their investors. They said we'll not touch LIC IPO.
LIC.
And coming to the multiple channels of insurance. So recently the video which has gone viral for HDFC,
Okay.
Pushpal Roy. Okay, you have seen, right?
Yeah, he was shouting at somebody or something. LinkedIn his lawyer.
It is not only LinkedIn, everywhere it is there, even in YouTube. Then they have made copy of that videos, like acting like Pushpal Rai. He was abusing the juniors.
Okay.
He was abusing the juniors. Now the things which we are saying, see, 10 health cover. Again, that is not a bank product, it's an insurance product. So that is the kind of arrangement which insurance companies are doing.
Okay.
Health cover is not a bank's product, it's an insurance product. Okay. But there is an arrangement with the bank, right?
Okay.
Okay. Thanks, guys.
Thank you.
Thank you. Okay. So obviously when we rate an insurance company, we will talk about the risk mitigation techniques, operational risk, management procedure, how the underwriting is being done, how the overall risk culture and governance is there. Now, when it comes to regulatory compliance, normally what comes into the picture is licensing and registration, capital adequacy, solvency and reserves, underwriting and pricing, market conduct and consumer protection. Very important nowadays, because I told you I had given you one instance where a consumer is free to write in an open forum like LinkedIn, and he will also loop in the insurance company and their MD even. And that can tarnish the image. A single video leakage of HDFC Bank has tarnished the image of entire work culture of HDFC. I don't know like in what condition that guy Pushpal Roy is there, and really, okay, a single video, this is the power of media. So consumer protection is very important. Investment regulations, so where they are investing the money, how much secured that insurance companies' investments are. Next is very important is anti-money laundering, which is a very big aspect. There are a lot of things included, that whether they are investing in any instrument which is in money laundering or not, that becomes important. Financial reporting and disclosures are important, and regulatory reporting and compliance monitoring is also very much important. This is a peer-to-peer comparison of certain insurance companies. Just have a look. Again, I got it from an open source. So it includes SBI Life, HDFC Standard, ICICI Prudential, Max Life, and Bajaj Alliance. Okay, can I go ahead? You guys can take a snip of this. If you want to take a snip, you can take a snip of this. These are some macroeconomic factors which affects rating of an insurance company. One is global market conditions, commodities or resources, economic infrastructure, and capital markets. So global recession, negative GDP growth, uncertain recovery is definitely a condition. High unemployment, which can lead to dropout ratio, high energy cost, which can lead to increase in the prices of all the products which are manufactured, rising prices, green movement. Yeah, I told you, I just given you an option, Tanuma. If you want to take a snip, you can. They are giving PPTs in the WhatsApp group. Fair enough. You don't take a snip. That's all. Right? Then in the capital markets, limited credit availability, little venture capital, increasingly volatile markets, target already has significant long-term debt. So even if the insurance company has got significant long-term debts, definitely it is going to affect the rating. Certain internal and external factors are there. So when we talk about the internal factors, that is, these are for bank, not the insurance company. This is for bank. The internal factors which we tell is location of the bank, layout or designing, defined goals and politics, clear-cut responsibility and duty, trade unions. So there are still in PSU banks, there are trade unions are there. How efficient is the management of the bank, financial solvency, financial discipline, service rendered, method of work, use of modern technology now, whether they are using AI, ML and all, and the bureaucratic competency. And among the external factors are socio-economic, socio-cultural factors, political, economic factors, legal factors. So when it comes to the question of the customers, whether the customers are loyal to the bank or not, whether the employees are loyal to the bank, whether the employees is having service oriented attitude or not, how many numbers of employees are there. So you can see three zones. One is internal factors, second is internal factors relation of bank with the customers, and the external factors. These are very important. This is a comparison between Basel 2 and Basel 3. So Basel 3 has enhanced minimum capital and liquidity requirements, enhanced supervisory process for firm-wide risk management and capital planning, and enhanced risk disclosure and market discipline. Well, this is Camel's rating, the last one. So when we talk about Camels, we mean capital adequacy, asset quality, management quality, earning, liquidity, and sensitivity. So these four factors I know you guys know. When I talk about sensitivity, what do I mean by sensitivity? What is sensitivity in Camel's rating? Can someone please answer this? What is sensitivity? Okay. So sensitivity is nothing but how sensitive the external factor is and how much a change in certain situation will lead to a change in your revenue or profitability. Right. So for an example, how much, like with a certain change in government policy, how your operational efficiency can get effective is something which is called as sensitivity. So normally when we eat something very cold or we take an ice cream or cold drinks, we get cold, and how much sensitive my body to something very cold that I get caught by it. Yeah, it's a part of actuary analysis. Right. So it is not, yeah. So one thing is government policy, changing interest rate, right? Changing some socio-economic factor, uh, could be the change in the technology, and how much sensitive it could be for overall performance of my bank or insurance company, right? Suppose there is an increase in interest rate. Now, once interest rate increase, does my lending does it affect my lending? Does it affect my deposits? So this is what is called sensitivity, right? Lifespan is increasing in a country, correct? Okay. So this session is up to this much, guys. Thank you for participating. Let us close. We'll catch up. Stay in this link only. We'll catch up once again at 10:30. Fair enough? Thank you. Thanks. Thanks, guys.